Well, the United States is sitting on an energy paradox. Washington released strategic reserves to protect American consumers, but the market is sending those barrels overseas instead. U.S. crude exports surged to a record last week, topping 6 million barrels per day. The trigger? Iran's war disruption that sent overseas buyers hunting for replacements to Gulf oil. American crude filled that gap fast, but here's the problem. On March 11th, the 32-member countries of the International Energy Agency, or IEA, they agreed to release 400 million barrels of oil from their strategic emergency reserves. That's the largest stock draw in the agency's history. The U.S. alone committed 172 million barrels from the Strategic Petroleum Reserve, or SPR. That was part of the coordinated IEA effort to address supply disruptions that were stemming from West Asia conflict. The stated goal cushioned domestic supply and cool prices at home. However, the outcome is different. Combined U.S. commercial crude and SPR inventories have now fallen by around 90 million barrels from their recent peak. That's including a 16 million barrel decline in just 1 week. The EIA's latest weekly print shows that commercial crude inventories, excluding the SPR, fell by 18 million barrels, sitting approximately 3% below the 5-year average. That's roughly double what analysts had modeled. Now, why is this gap? Because the SPR releases are hitting Gulf Coast terminals. Global buyers, squeezed by Hormuz disruptions, are paying the premium. The barrels exit before domestic refineries absorb them. The 400 million barrels slated for release represents 33% of the total IEA member stockpiles. The 172 million barrels that the U.S. plans to release presents 41% of its own strategic petroleum reserve. Washington is burning its emergency buffer at record pace. The buffer was built for Americans, but the market is routing it to Rotterdam and Asia instead. The IEA projects global inventories fell by an average of 8.5 million barrels per day during the current quarter, the fastest depletion rate in the agency's 52-year history. The SPR isn't a domestic shock absorber right now. It's functioning as a subsidized export mechanism for global crude markets. Wall Street isn't pricing that risk correctly, and that's the signal that the market is missing.